Welcome. You're here because you want to get straight to the insights, right? You've got the source material, articles, memos, and you want the core knowledge fast without the overload.
Exactly. Think of this as your accelerated briefing.
Our mission today is pretty specific. We're looking at a U.S. digital nomad, earns $300,000 a year through a single member S-Corp. How do they minimize U.S. taxes? Legally, of course.
Right. And we've got some dense but really useful stuff here. Tax strategies, a detailed memo on one person's approach. We're calling him Alex.
Okay, Alex, let's unpack how he's structuring his income using tax benefits.
Yeah.
Basically how he keeps more cash. Let's dive in.
Okay, so the absolute foundation here is how Alex's $300K is split up within his S-Corp. It's not all one big pot for tax purposes. That division, crucial.
Right. I see the breakdown. $180,000 comes out as salary, like W-2 wages, regular paycheck, taxes withheld. Yeah.
Yep, standard salary.
Then there's a $45,000 employer contribution to a solo 401k. We'll get into that, I'm sure. And finally, $75,000 comes as an S-Corp distribution. That's on a K-1 form, showing his share of the profit.
Exactly. That's the profit share, essentially.
Okay, but that $180,000 salary seems pretty high. Why not, take less salary and more of that distribution? Seems like that would save on some taxes.
That's where the reasonable compensation rule comes in.
Yeah.
The IRS insists S-Corp owners pay themselves a fair wage for their work before taking profit distributions.
So you can't just pay yourself a tiny salary.
Nope. If it looks too low, the IRS might just say, hold on, those distributions look like wages, and boom, you owe payroll taxes on them.
Ah, okay. So how is $180K considered reasonable here?
Well, it's about 60% of the total $300 gross income. For the kind of work likely generating that revenue, it's seen as reasonable. Plus, it hits the maximum Social Security wage base for 2025, which has its own benefit.
Benefits like building up Social Security for retirement.
Exactly. It's compliant, avoids IRS issues, and sets them up for maximum Social Security benefits later. It's a bit of a balancing act.
Got it. Compliant, long-term thinking. But where's the immediate win? The tax saving.
The big immediate win is on that $75,000 distribution. See, unlike salary, S-Corp distributions aren't subject to FICA taxes. That's Social Security and Medicare.
Okay.
If that $75K was salary, he'd pay roughly 15.3% in payroll taxes on it, both the employee and employer share since it's his company.
So taking it as a distribution saves, doing the math, around $11,000.
Roughly, yeah.
Okay.
About $11,000 saved just on that portion by structuring it as a distribution instead of salary.
Wow. Okay. So effectively, 40% of his business earnings, that $75K distribution, plus the $45K retirement contribution, which also lowers profit, that chunk avoids FICA tax.
Precisely. A big slice of the income becomes FICA-free because of that S-Corp structure.
Okay, S-Corp structure, reasonable salary, FICA savings on distributions, that's piece one. What's next for Alex, being a digital nomad?
The next up is a really powerful tool, the Foreign Earned Income Exclusion, the FEIE. Huge for U.S. citizens working abroad.
Right, the FEIE. But you have to actually be abroad, correct? You can't just claim it.
Absolutely. You need to meet the physical presence test. That means being physically in a foreign country, or countries, for at least 330 full days within any 12-month stretch.
Yeah.
Alex meets this.
And for 2025, how much can he exclude?
The maximum exclusion for 2025 is $130,000.
Okay, so Alex just knocks $130,000 off his $300K income. Simple as that.
Not quite. It's a bit more nuanced. The FEIE only applies to earned income.
Which is his salary, right, the $180K.
Exactly. It applies to the $180K salary, not the $75K distribution that's considered unearned or passive income in this context. So he excludes $130,000 of the $180,000 salary.
Leaving $50,000 of his salary still taxable.
Correct. $50,000 is salary plus the full $75,000 distribution. So his total income subject to U.S. tax is $125,000.
But I remember reading something, a stacking rule. How does that complicate things?
Yes, the stacking rule. Crucial detail. Even though $130,000 is excluded, the IRS doesn't just tax the remaining $125K as if that's all he earned. They look at his total income, the $125K taxable part, plus the $130K excluded part, to figure out which tax brackets apply to the taxable $125K.
So wait, the excluded income pushes the taxable income into higher brackets than it would be otherwise.
That's exactly it. Think of it like layers. The FEIE takes the bottom $130K off the taxable pile, but the tax rate applied to the remaining pile is based on the height of the original full pile.
Huh. So the benefit is still there, but it's maybe not as dramatic as just taxing 125K starting from the lowest bracket.
Precisely. It stops people from getting a double benefit, excluding income, and having the rest taxed at super low rates. It means the FEIE is most valuable when your income is already pushing you into higher brackets anyway.
Interesting. Okay, that makes sense. Prevents a loophole, I guess. So S-Corp, FEIE with stacking. What else is in Alex's tax toolkit?
Retirement contributions. He's maximizing them using a solo 401k. This is great for self-employed people as small business owners.
Solo 401K allows contributions as both the employee and the employer, right?
Correct. So let's break down what he's doing.
Yeah, what are the numbers?
As the employee of his own S-Corp, he's putting in $23,500. That's the max employee deferral for 2025 if you're under 50. And he's doing this as a Roth 401k contribution.
Roth means after tax, right? So no upfront tax deduction for that $23,500.
Exactly. He pays tax on it now. But the growth and qualified withdrawals in retirement, tax-free.
Okay, paying tax now for tax-free later. What about the employer contribution?
As the employer, his S-Corp contributes $45,000. This one is pre-tax.
Ah, so this part reduces taxes now.
Yes. It's a deductible business expense for the S-Corp. That lowers the company's profit, which in turn lowers Alex's K-1 distribution income. This $45K grows tax deferred, meaning he'll pay income tax when he withdraws it in retirement.
So combined, that's $68,500 going into the solo 401K. That's a lot.
It is. And it's near the maximum total contribution allowed for 2025. But wait, there's more.
More retirement savings.
Yep. He's also doing a Backdoor Roth IRA contribution, another $7,000 for 2025.
Backdoor Roth IRA. Why backdoor?
Because his income, $300, is too high to contribute directly to a Roth IRA. The limits are much lower.
See, how does a backdoor work?
He contributes $7,000 to a traditional IRA, which he can't deduct because he has a workplace plan and high income, and then immediately converts that traditional IRA contribution to his Roth IRA. It's a standard workaround.
Clever. So add that $7,000, we're at $75,500 total going into retirement accounts.
Around that, yes. About 25% of his gross income.
And it's a mix, some Roth for tax-free futures, some pre-tax for tax savings now.
Exactly. That $45K employer contribution gives him a nice immediate tax deduction via the S-Corp. It's a balanced approach.
Okay, we've hit income tax with FEIE, retirement. Let's circle back to payroll taxes, FICA. We know the distribution saves taxes, but what about the 180K salary?
Right. Even with the FEIE lowering his income tax, that 180K salary is still subject to U.S. payroll taxes because he's employed by his U.S. S-Corp.
So Social Security first. That's 6.2% from employee, 6.2% from employer.
Correct. But it's capped. For 2025, the maximum wages subject to Social Security tax are $176,100. Since his salary is $180K, he pays the maximum Social Security tax.
Okay, maxes out Social Security. What about Medicare?
Medicare is 1.45% each, employee and employer, and there's no wage limit on Medicare. So that applies to the full $180,000.
Is there that extra Medicare tax for high earners?
Good question. There's an additional 0.9% Medicare tax, but it kicks in for single filers above $200,000 in wages. Since Alex's salary is $180K, he avoids that extra tax.
Okay, so total FICA tax on the $180K salary is what, roughly?
Adding up the employee and employer portions for both Social Security up to the cap and Medicare on the full amount, it comes out to about $27,056 for 2025.
And just to reiterate, the $75K distribution is completely free of that $27K FICA hit.
Completely free. That's the key S-Corp advantage here versus, say, being a sole proprietor where pretty much all the profit would get hit with self-employment tax, which is equivalent to both halves of FICA.
Okay, huge difference. All right, we have all the pieces. S-Corp, FEIE, retirement, FICA. Let's put it together. What's the final tax calculation, the bottom line?
Let's calculate it. First, adjusted gross income, AGI. That's the $50,000 taxable part of his wages, plus the $75,000 S-Corp distribution. So $125,000 AGI. Remember, the Roth contributions don't lower AGI.
Okay, $125K AGI, then standard deduction.
Right. For a single filer in 2025, the standard deduction is $15,000. So $125,000 minus $15,000 gives us taxable income of $110,000.
$110,000 taxable income. Now, calculating the actual income tax. This is where that stacking rule bites.
This is exactly where it shows up. You don't just calculate the tax on 110K using the lowest brackets. Because of stacking, the tax rate is determined as if his income started above the excluded 130K.
So the tax is higher than you'd think for 110K taxable income.
Correct. The estimated federal income tax comes out to around $30,000, significantly higher than if stacking didn't apply.
Okay, $30K income tax plus the $27,056 in FICA taxes we calculated earlier.
Add those together, and his total estimated federal tax liability is roughly $57,000.
$57,000 out of $300,000 gross. What's that as an effective rate?
That's an effective federal tax rate of about 19%. And like I said, that could maybe dip lower if he has other deductions like the foreign housing exclusion, which we didn't even factor in here.
19%. That sounds pretty good for $300 K income. How does it compare if he wasn't a digital nomad using these strategies? Like, same income but living and working in the U.S.
But the difference is stark. A U.S. resident earning $300K W-2, just taking the standard deduction, no fancy stuff, they'd be looking at an effective federal rate closer to 35.7%.
35.7%. That's, wow. How much tax is that?
That's roughly $107,000 in total federal taxes.
So Alex, with his setup, is paying less than half, around 57K versus 107K.
Exactly. Less than half the federal tax burden compared to a purely domestic counterpart with the same income. Huge difference.
It really shows the power of combining these strategies. So let's track Alex's cash. Out of the $300 K, where does it all go?
Okay, quick breakdown. About 25% of the $75,500 goes straight into retirement savings.
Right.
About 19%, the $57,000, goes to Uncle Sam for federal taxes.
Okay.
Which leaves the rest, about 56% or roughly $167,500, as his net take-home pay. That's composed of his net salary after deductions and taxes, plus that FICA-free distribution.
$167,500 take-home after maxing retirement and paying taxes. Seems like a solid outcome.
It's a very tax-efficient outcome for that income level and situation.
We've hammered home the S-Corp benefits here. Just quickly, how bad would it look if Alex was, say, a sole proprietor instead? Same income, same nomad status.
As a sole proprietor, the big hit would be self-employment tax. Basically, that entire $300 K profit, minus some deductions, would be subject to the full 15.3% SE tax, up to the Social Security limit, plus Medicare on everything. Way higher payroll taxes than the S-Corp route.
Ouch. And a C-Corp. Any better?
Generally worse for this scenario. C-Corp faced double taxation. The corporation pays corporate tax first. Then, when Alex takes money out as dividends, he pays tax again on his personal return. S-Corp avoids that second layer of tax on distributions.
So S-Corp really seems like the sweet spot for this specific situation. Avoids double tax, allows FICA savings.
For a single owner-operator digital nomad earning this kind of income, yes. The S-Corp structure combined with FEIE and retirement maximization is often the most tax-efficient path.
Now, there was also that mention of a Roth Max scenario in the appendix of our source material. What's that about?
Right, the Roth Max. It's an alternative approach.
Huh.
Remember that $45,000 pre-tax employer contribution to the Solo 401k in our main scenario?
Yeah, the one that lowered his current taxes.
In the Roth Max version, he'd elect to treat that contribution as Roth too. So it would be made with after-tax dollars, just like his employee contribution.
So the entire $68,500 going into the 401k plus the backdoor IRA would all be Roth.
Correct. $75,500 total going into Roth accounts for the year.
But the trade-off must be higher taxes now, right? Since that 45K isn't pre-tax anymore.
Exactly. Making that 45K taxable now would increase his current federal tax bill. The estimate was around an extra $15,000 in tax for the year.
So total tax around $72,000 instead of $57,000.
Roughly, yes.
Oh.
Higher tax today. But the potential upside is having that entire $75,500 pot grow completely tax-free for retirement. Withdrawals later would be tax-free.
So it's a bet on future tax rates being higher or just valuing tax-free income in retirement more than saving taxes today.
Pretty much. It depends on your view of future taxes, your current cash flow needs, and your overall retirement strategy. The main scenario we detailed prioritized minimizing the current year's tax bill. The Roth Max prioritizes future tax-free growth.
This has been incredibly detailed, thanks. So summing it up, for a high-earning digital nomad like Alex, it's this combination, isn't it? S-Corp structure, really using that foreign earned income exclusion, and aggressively saving for retirement. These aren't loopholes. They're established strategies used correctly.
Absolutely. It's about understanding how the rules for business structures, international work, and retirement savings all fit together. When you layer them strategically, the tax reduction can be substantial, and it's fully compliant.
Right. It really highlights how crucial it is to understand these different tax levers and how they interact. It's not just one thing, it's the whole package.
Precisely. The synergy between the strategies is key.
So for you listening, especially if you're navigating similar waters, it raises a really interesting question. What's your priority? Is it minimizing the tax you pay right now, like in Alex's main strategy, or are you more focused on maximizing potentially tax-free income decades down the road, like that Roth Max idea suggests?
It's a fundamental planning question with long-term implications. There's no single right answer. It depends entirely on your personal circumstances, risk tolerance, and financial goals.
Definitely something to mull over. Hopefully this deep dive gives you a solid framework for thinking about these complex strategies.